The year is 2026, and an invisible hand is reshaping the global economy, subtly yet profoundly. This isn't merely about interest rate adjustments or market corrections, it's a far more intricate phenomenon we're calling the reset. For years, central banks and global financial institutions have been responding to the unprecedented economic anomalies of the early 2020s, the pandemic, supply chain disruptions, and inflationary pressures, with a series of interconnected policies that, when viewed holistically, paint a picture of a deliberate re-engineering of our financial architecture. The reset extends far beyond simple monetary policy. It encompasses the accelerated development of central bank digital currencies, the fervent push towards green finance mandates, and a strategic re-onshoring of critical supply chains. These initiatives, while often presented as separate, necessary adjustments, are in fact threads in a larger tapestry, woven with the unspoken aim of establishing a new economic paradigm for the next decade and beyond. We are witnessing a foundational shift designed to address perceived fragilities within the existing system, but with consequences that ripple through every layer of society. One of the most immediate and visible effects of this reset is the sustained period of monetary tightening. High interest rates and quantitative tightening, while intended to curb inflation, have an undeniable and often disproportionate impact. Highly leveraged businesses, particularly those reliant on readily available, cheap credit, find themselves in an increasingly precarious position. Their cost of capital skyrockets, pushing many to the brink or forcing drastic restructuring. Emerging markets, historically vulnerable to capital outflows during periods of global monetary tightening, are feeling an intense squeeze, grappling with currency depreciation and increased debt servicing costs. On the home front, we observe a widening wealth gap. As asset prices adjust to higher rates, the dynamics of wealth accumulation shift dramatically. Those with significant capital can weather the storm, or even profit from market volatility, while everyday citizens face an increasingly challenging landscape. Borrowing costs for mortgages, car loans, and credit cards have soared, directly impacting the purchasing power and financial stability of Main Street. This creates a stark contrast between institutional investors, who may find opportunities in distressed assets, and the average individual, who is simply trying to keep pace. Furthermore, the lingering effects of inflation, even as central banks attempt to tame it, coupled with stagnant real incomes, mean that the erosion of purchasing power for wage earners continues unabated. The cost of living rises, while salaries struggle to keep pace, leading to a palpable sense of economic insecurity for many. This isn't just about statistics, it's about the very real struggle of families to afford necessities, to save and to plan for the future. The foundational premise of the reset is that these are necessary adjustments for long-term stability, but for those experiencing the squeeze, the short-term pain is intensely real and immediate. The grand design of this new financial architecture is still unfolding, and its ultimate beneficiaries and casualties are becoming clearer with each passing development. We must delve deeper into these unfolding dynamics to understand the full scope of this transformation. The digital dollar divide, often framed as an inevitable evolution of currency, represents another monumental shift within this reset. Deconstructing the motivations behind the accelerated development of central bank digital currencies, or CBDCs, reveals a complex interplay of efficiency, control, and national security. Proponents argue that CBDCs offer a more secure, efficient, and inclusive payment system, reducing transaction costs and combating illicit financial activities. By digitizing a nation's currency, central banks could theoretically gain greater oversight, allowing for more precise monetary policy implementation and potentially faster distribution of aid during crises. However, a deeper examination uncovers significant concerns regarding privacy and financial freedom. Unlike physical cash, which offers a degree of anonymity, a fully digital currency system could grant governments unprecedented visibility into individual spending habits. Every transaction, every financial interaction could become a data point, potentially enabling granular control over economic activity. This raises critical questions about the line between legitimate oversight and intrusive surveillance. Could specific types of purchases be restricted? Could accounts be frozen or funds deactivated based on social or political criteria? These are not hypothetical fears, but possibilities inherent in a system where the state holds the keys to every digital wallet. The potential for governments to dictate investment flows and consumer spending through CBDCs is a particularly salient point. Imagine a scenario where central banks could program money to expire if not spent by a certain date, or to be used only for specific goods or services. While this might be presented as a tool to stimulate economic activity or direct funds towards national priorities, it fundamentally alters the individual's autonomy over their own finances. This shift from a decentralized, cash-based system to a centralized, programmable digital one represents a profound change in the relationship between the citizen and the state, with financial power consolidating at the top. Identifying the sectors and individuals poised to gain immense power from a fully digitized monetary system is crucial. Financial technology companies, particularly those involved in blockchain infrastructure and digital payment processing, stand to benefit enormously from the widespread adoption of CBDCs. Governments, of course, would acquire an unparalleled instrument for economic management and data collection. On the other hand, those who risk being left behind include segments of the population without reliable access to digital infrastructure, individuals prioritizing financial privacy, and small businesses reliant on cash transactions. This digital divide could exacerbate existing inequalities, creating a two-tiered financial system. Beyond the digital realm, we observe a strategic accumulation of wealth in specific sectors, a phenomenon that intensifies during periods of economic flux. Large corporations and ultra-high net worth individuals are making strategic pivots into what are deemed recession-proof assets, critical infrastructure, and advanced technologies. This isn't merely opportunistic buying, it's a calculated repositioning to dominate the emerging economic landscape. Think of investments in renewable energy, artificial intelligence, biotechnology, and essential logistics, sectors that are either fundamental to the future economy or provide indispensable services regardless of economic cycles. This strategic accumulation is often facilitated by continued access to cheap capital, even in a tightening monetary environment, and by favorable regulatory environments that allow certain entities to consolidate market power. While average consumers face higher borrowing costs, well-connected corporations can still leverage their scale and influence to secure financing on advantageous terms. This creates a feedback loop where the already powerful grow stronger, acquiring distressed assets at significant discounts from smaller, less resilient competitors. The mechanisms at play include mergers and acquisitions, private equity buyouts, and direct investments in foundational industries, all contributing to a widening chasm between the few who control vast resources and the many grappling with economic uncertainty. This process further concentrates wealth and influence, reshaping the competitive landscape and solidifying the positions of established titans. Navigating this new financial frontier requires a blueprint for resilience, a proactive stance rather than a reactive one. For individuals and small businesses, adapting to this evolving economic landscape demands a multi-pronged approach, focusing on debt reduction, diversification, and skill acquisition. Debt, particularly high-interest consumer debt, becomes an anchor in an environment of rising rates and stagnant wages. Reducing this burden frees up capital, enhancing financial flexibility, and reducing vulnerability to economic shocks. This isn't just about personal finance. For small businesses, managing leverage effectively can be the difference between survival and insolvency when credit markets tighten. Diversification, traditionally applied to investment portfolios, now extends to income streams and skill sets. Relying on a single source of income or a narrow professional skill set becomes increasingly risky as industries transform and automation advances. Cultivating multiple income streams, whether through side hustles, freelancing, or investing, provides a crucial buffer. Similarly, continuous learning and skill acquisition, particularly in areas resistant to automation or aligned with emerging technologies, enhance employability and adaptability. Beyond personal strategies, understanding geopolitical shifts is paramount, as they exert a direct and often profound impact on local economies and investment opportunities. The re-onshoring of supply chains, for instance, driven by national security concerns and a desire for resilience, creates opportunities in domestic manufacturing and logistics while potentially disrupting international trade flows. Trade wars, sanctions, and shifting alliances can open or close markets, affecting commodity prices, consumer goods availability, and investment returns. For instance, a focus on energy independence in one region might spur investment in domestic energy infrastructure, while simultaneously impacting global oil markets. Keeping abreast of these macro-level dynamics allows for more informed decision-making, whether it's choosing a career path, making investment choices, or even planning for retirement. Empowering viewers to identify emerging trends and prepare for the long-term implications of the reset is not about predicting the future with certainty, but about building adaptive capacity. This involves critical thinking about the narratives presented by mainstream media and official sources, cross-referencing information, and developing a nuanced understanding of underlying economic forces. For example, while digital currencies are often framed as efficiency tools, their potential for central control warrants careful consideration. Similarly, green finance initiatives, while laudable in their environmental goals, can also redirect capital flows and create new monopolies. The ability to discern genuine innovation from speculative bubbles, to differentiate between necessary adjustments and exploitative practices, becomes a vital skill. This requires a willingness to look beyond immediate headlines and understand the broader historical and economic context. By doing so, individuals and small businesses can position themselves not merely as passive recipients of the reset's effects, but as active participants capable of shaping their own financial destinies. This involves discerning where capital is truly flowing, identifying sectors poised for growth, and understanding the regulatory frameworks that will govern future economic activity. It means looking at the world not just as it is, but as it is rapidly becoming, and building strategies that anticipate those changes rather than reacting to them after the fact. The ultimate goal is to foster resilience and autonomy in an increasingly complex and centralized global economic system. The strategic accumulation of wealth during this period of the reset reveals a clear pattern. Large corporations and ultra-high net worth individuals are making significant pivots into what can be broadly categorized as recession-proof assets, critical infrastructure, and advanced technologies. This isn't merely opportunistic buying, it's a calculated long-term positioning. For instance, in times of economic uncertainty, demand for essential goods and services rarely diminishes. Consequently, sectors like utilities, healthcare, and consumer staples become attractive havens. These are industries where established players with robust balance sheets can further consolidate their market share, often acquiring smaller, financially vulnerable competitors. Beyond traditional defensive plays, there's a pronounced shift towards critical infrastructure. This encompasses everything from energy grids and water treatment facilities to transportation networks and telecommunications. Governments, often constrained by budget limitations and political cycles, are increasingly open to private investment in these areas. For large corporations and institutional investors, these assets offer stable, long-term returns, often backed by government contracts or regulated monopolies, making them highly resistant to economic downturns. The inherent necessity of these services ensures consistent revenue streams, providing a bedrock for wealth preservation and growth amidst volatility. Furthermore, advanced technologies are receiving unprecedented investment. This includes artificial intelligence, biotechnology, quantum computing, and renewable energy solutions. These are not merely speculative ventures. They represent the foundational pillars of the next economic era. Companies with proprietary technology or significant intellectual property in these fields are becoming increasingly valuable. The investment here is often less about immediate profit and more about securing future market dominance. Those with the foresight and capital to invest heavily in research and development or to acquire innovative startups are positioning themselves to dictate the terms of future industries. This strategic pivot ensures that they are not just participating in the evolving economic landscape, but actively shaping it. A critical factor enabling this concentration of wealth is the persistent access to cheap capital for these large entities, even as interest rates rise for the general public. While Main Street businesses face increasingly stringent lending conditions and higher borrowing costs, global corporations and institutional investors often have access to diverse funding mechanisms, including corporate bonds, syndicated loans, and private equity, often at more favorable terms. This disparity creates an uneven playing field, where those with existing capital can leverage it more effectively. Moreover, favorable regulatory environments, sometimes explicitly designed to attract large-scale investment, further facilitate this consolidation. Tax incentives, relaxed antitrust enforcement in specific sectors, and streamlined approval processes can all contribute to an environment where large players can grow unimpeded. This dynamic allows certain entities to consolidate market power during periods of economic flux. When smaller businesses struggle with rising costs, supply chain disruptions, or reduced consumer spending, they become prime targets for acquisition. The larger players, with their deeper pockets and greater operational efficiencies, can absorb these smaller entities, eliminating competition and expanding their reach. This isn't just about market share. It's about control over entire value chains, from raw materials to distribution. By integrating these various components, they can achieve greater economies of scale, reduce costs, and ultimately exert more influence over pricing and supply. The mechanisms by which institutional investors and global corporations are acquiring distressed assets at significant discounts further widen their lead. During economic downturns or periods of industry upheaval, many assets, whether real estate, businesses, or even entire portfolios, become undervalued. Companies facing bankruptcy, individuals needing to liquidate assets quickly, or governments divesting state-owned enterprises, all present opportunities for those with ready capital. These acquisitions, often executed through private equity funds or specialized investment vehicles, allow sophisticated players to buy low and position themselves for substantial gains when the market recovers. This cycle of acquiring distressed assets at a discount and then leveraging them for future growth is a powerful engine for wealth concentration, further solidifying the position of those already at the top of the economic hierarchy. This process, while often presented as natural market correction, fundamentally reshapes ownership and control over productive assets, deepening existing inequalities and setting the stage for a new economic architecture dominated by a select few. Navigating this new financial frontier requires a considered approach, a blueprint for resilience that extends beyond traditional financial advice. For individuals and small businesses, adapting to this evolving economic landscape means focusing on fundamental principles while simultaneously embracing forward-looking strategies. One primary actionable insight is debt reduction. In an environment of sustained higher interest rates, carrying significant debt becomes an increasingly heavy burden, diverting resources that could otherwise be allocated to growth or savings. Prioritizing the elimination of high-interest debt, such as credit card balances or even reevaluating mortgages with adjustable rates, can significantly bolster financial stability. Beyond debt management, diversification emerges as a critical shield against volatility. This isn't solely about diversifying investment portfolios across different asset classes, though that remains vital. It also encompasses diversifying income streams, acquiring new skills, and even exploring geographical diversification where feasible. For small businesses, this might mean broadening their customer base, exploring new product lines, or implementing adaptable business models that can weather economic shocks. For individuals, investing in continuous learning and skill acquisition ensures relevance in a rapidly changing job market, particularly as automation and AI continue to reshape industries. The ability to pivot and adapt becomes a valuable currency in itself. Understanding geopolitical shifts is another crucial component of this resilience blueprint. The world is increasingly interconnected, and events in one region can have profound and immediate impacts globally. Supply chain disruptions, trade wars, energy crises, and political instability are no longer distant concerns but direct factors influencing local economies, inflation rates, and investment opportunities. For instance, understanding the implications of a shift towards deglobalization or the re-onshoring of manufacturing can inform investment decisions, career choices, and even consumption patterns. Those who can anticipate these macro trends are better positioned to mitigate risks and identify nascent opportunities. This requires moving beyond traditional financial news and engaging with a broader spectrum of global economic and political analysis, recognizing that capital flows are often dictated by geopolitical considerations as much as by pure economic fundamentals. Empowering viewers to identify emerging trends and prepare for the long-term implications of the reset, rather than merely reacting to them, is paramount. This proactive stance involves critically assessing the narratives presented by mainstream media and financial institutions. For instance, while digital currencies are often framed solely through the lens of innovation, it's crucial to also consider their potential for increased surveillance and control. Similarly, discussions around green finance should be analyzed not just for their environmental benefits, but also for their economic implications, including potential costs to traditional industries and the creation of new monopolies. The long-term implications of the reset point towards a more centralized, digitized, and potentially less equitable global financial system. Preparing for this means fostering financial literacy, understanding the mechanics of monetary policy, and recognizing the power dynamics at play. It means questioning assumptions about economic growth and prosperity, and instead, focusing on building personal and community resilience. This shift in mindset from passive consumer to active participant in one's financial destiny is perhaps the most critical insight for navigating the complex terrain ahead. It's about not just surviving, but strategically positioning oneself for whatever future emerges from these profound economic transformations. This proactive stance involves critically assessing the narratives presented by mainstream media and financial institutions. For instance, while digital currencies are often framed solely through the lens of innovation, it's crucial to also consider their potential for increased surveillance and control. Similarly, discussions around green finance should be analyzed not just for their environmental benefits, but also for their economic implications, including potential costs to traditional industries and the creation of new monopolies. The long-term implications of the reset point towards a more centralized, digitized, and potentially less equitable global financial system. Preparing for this means fostering financial literacy, understanding the mechanics of monetary policy, and recognizing the power dynamics at play. It means questioning assumptions about economic growth and prosperity, and instead, focusing on building personal and community resilience. This shift in mindset from passive consumer to active participant in one's financial destiny is perhaps the most critical insight for navigating the complex terrain ahead. It's about not just surviving, but strategically positioning oneself for whatever future emerges from these profound economic transformations. Ultimately, the reset is not a single event, but a complex, ongoing process of economic re-engineering driven by a confluence of technological advancements, geopolitical pressures, and institutional responses to perceived global crises. On one hand, proponents argue that these changes are necessary to address systemic vulnerabilities, promote environmental sustainability, and enhance financial stability. They envision a more efficient, transparent, and resilient global economy capable of responding swiftly to future shocks. Digital currencies, for example, are touted for their potential to reduce transaction costs, increase financial inclusion, and combat illicit activities. Green finance initiatives are presented as essential tools for mitigating climate change and fostering sustainable development, aligning economic incentives with ecological imperatives. From this perspective, the shifts are a pragmatic evolution, guided by expert consensus and aimed at long-term collective benefit. On the other hand, critics raise significant concerns about the concentration of power, the erosion of individual freedoms, and the potential for increased societal stratification. They argue that the very mechanisms designed for stability and efficiency could inadvertently create new forms of control and exclusion. The centralization inherent in CBDCs could grant governments unprecedented oversight of citizens' financial lives, potentially leading to social credit systems or targeted economic sanctions. The rapid consolidation of wealth and assets by large corporations and institutional investors, often facilitated by favorable policies, could further entrench existing inequalities, making it harder for small and medium-sized enterprises to compete and for individuals to build intergenerational wealth. The transition to a green economy, while laudable in principle, could inadvertently benefit established players with deep pockets, while imposing significant burdens on developing nations and traditional industries. The interplay between these perspectives suggests a future that is far from predetermined. The trajectory of the reset will largely depend on the ongoing dialogue, the balance of power between various stakeholders, and the vigilance of an informed populace. Will the drive for efficiency and control lead to a technocratic dystopia, or will it be tempered by robust protections for privacy and individual autonomy? Will the pursuit of sustainability inadvertently create new monopolies, or will it foster a genuinely inclusive and decentralized green economy? The answers remain elusive, lying in the choices made today and the awareness cultivated among citizens, businesses, and policymakers alike. The ultimate outcome of the reset is not a fixed destination, but a dynamic process, shaped by human agency and the ongoing negotiation of values. It demands a critical engagement with the evolving financial landscape, a commitment to understanding its multifaceted implications, and a proactive approach to shaping a future that serves the broadest possible interests, rather than merely accommodating the dictates of an invisible hand. The challenge, and indeed the opportunity, lies in navigating this complex transformation with wisdom, foresight, and a steadfast commitment to equitable progress.